Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, let's do another example. Next screen. Here are another couple bullish spreads, and I'm looking at the EUI, which is the Euro index. This is the dollar relative to the euro. Let's say that I drew in a red line here, which most people would refer to as a resistance line. Okay, and why did I call that a resistance line, and why did I draw it there? Well, if you go back all the way to May, you can see that this index came right down to right about on June 1st. It hit that line and turned around and went higher. Then it came back down that line again in late July and bounced higher. Then at the beginning of August, it broke through sharply. Now when an index or anything breaks through a support line, what happens? Well, it becomes a resistance line. Did that happen? Well, not really. It broke back up above it again, consolidated around it for a while in August. Then in September, it broke sharply below it, and it was under it for several months. Now, as we get closer to December, you can see that it came right about back up to that line, which previously was support and now has become resistance. And for several weeks, in late December and early January, this index came up and hit that line numerous times and could not get through it. So it created a pretty solid level of resistance where the old support line used to be. Then what happened in January? Well, you can see it came up to that line, and then it broke through it with a big solid day, a big gap up day. Well, what that does then is it reestablishes that line now as a support line because it's above the resistance. It broke through. Once it breaks through a resistance, it becomes support. Once it falls through support, it becomes resistance. So at this point, I'm looking at this, and I've got two conclusions. I can say two things, my two bullet points at the top. I'm expecting more upside, and the reason I am is because I've just broken through the resistance. And now I'm looking for the upside again. Now you may look at this and from a technical perspective come to a different conclusion. That's the conclusion I came to. It's okay if you don't agree with me on that. The main thing is that you have the ability and the understanding of how to use a vertical spread to capitalize on whatever your opinion might be. If you disagree with me and think this is going down instead, then that's fine. Do a bearish spread, and we'll look at a couple of those examples. But how do you decide what spread to do? Well, you have to first of all, you got to pick direction. We've already done that. We said we're bullish. Secondly, you've got to pick the magnitude, which is how bullish am I? Am I slightly bullish or neutral? Am I moderately bullish or am I extremely bullish? Well, in this example, I chose two. I chose a moderately bullish one, which is an at-the-money spread, meaning like in the previous example that the one leg is in the money and one leg is out of the money. And I chose a very aggressive trade, which is an extremely bullish trade, where both legs of the spread are out of the money. Well, you can see that if you look at the beige zone, that's the break-even to max profit zone of the first spread, which is an at-the-money spread. I'm going to buy a $70 put, which you can see is out of the money by 90 cents because the current index is at 70.90. And I'm going to sell a $72 put, which is in the money by about $1.10. This is a credit put spread. The last example we were bullish, we did debit call spreads. In this example, I'm bullish. I'm going to do credit put spreads. These are the types of spreads I like to do. This trade is done at a net credit of 97 cents. In this case, that would be a 10 by 10, so that's $970. Just like in the example in the previous where I talked about when I do a debit spread, my goal is to have both options expire in the money. When I do a credit spread, my goal is to have both options expire out of the money, worthless, because my goal is to keep as much of that 970 as I can, hopefully all of it. This is a 2-point spread because I bought the 70s and sold the 72s. I got a credit of 97, so that's my max gain. My max loss is the difference between the 2-point spread and the 97, or $1.03. So this one's got pretty close to a 1-to-1 relationship. The amount of max gain and max loss are very close to each other. So there's about a 50-50 here. What about my break even? Well, on a credit spread, you do your break even is a little different. You start out again with your main position, which again is the expensive leg. In this case, that's the 72. and you subtract the amount of the credit. 72 minus the credit of 97 brings me to a break-even of 71.03. Well, look where the index is at right now. It's at 70.90. In order to get to break-even, in order to make any money at all on this spread, I need this index to at least get up to 71.03, which happens to be at the bottom of that beige zone. And as you can see, that's just slightly above the current candle and where it's at right now. If it doesn't get at least up to 71.03, I'm not going to make any money, right? I'm going to lose. If it gets up to 71.03, great, and ideally I want it to get all the way up to at least 72, which is the top of that beige zone. Actually, anything above 72 is great, but I don't want to go too far because then I will have lost some opportunity. I'll have wished that I had done a more aggressive trade, which we'll talk about here next. So if you can look at that and visualize it and go, okay, let me see now. This index has not been in that beige zone since way back in July, and it's now January. So 6 months ago before we actually were in this zone. But clearly back in July and June and then definitely back in May, we spent quite a bit of time in this zone. So it certainly seems very possible. And in fact, the last time this particular index broke through this red line, which was in August, it got up very close to that beige zone, but not quite. But back in June, when it broke through, it was well up in there. So I mean, essentially, if you believe that between now and the February expiration, you're going to get action on that index that's going to look similar to what we saw last June, then this is probably the perfect spread, because you can see that in June it spent a lot of time, and in fact it was in that zone, or right above the top, right at the top of that zone, as of about the June expiration, right around that time, which would be ideal. Now, if you believe, hey, we're breaking out into new zone, and we're going to go back and hit the old highs, which occurred way back in May, which are not only in this beige zone, but way above that, then we can put on a much more aggressive trade that has the potential to make a much larger profit, but we got to get a really substantial move, and that would be the blue trade, which is the in-the-money credit put spread. And remember, your goal on the credit spread, again, is to have both options expire worthless. That only happens if the index rises above both strike prices. Well, I'm starting out with in-the-money credit put spread, which means both strikes are already in the money. If my goal is to have them both be out of the money, then I'm going to need a pretty substantial upside movement in this index in order for that to happen. Well, where exactly does this index have to go? Well, it has to go all the way above the highest strike price, which in this case is 74. Right now, I'm only at 70.90, so that's a pretty substantial move. So you can see why this is a very aggressive trade. It's going to need a significant amount of movement in order for me to hit my max profit. Now, I can have a pretty sizable profit if that happens. This is a 2-point spread. I'm buying the 72s, which are quite a bit in the money, by $1.10, and I'm buying the 74s, I'm selling the 74s, which are $3.10 in the money. Quite a bit in the money. So I need this index to rise sharply. In order for me to even break even, I got to get up into the bottom of that blue zone, which is at 72.50, again calculated as my main position strike, in this case the expensive leg of 74, minus my credit of $1.50, sets my break even at 72.50. My index is at 70.90, so I've got to go all the way through the beige zone and all the way to the bottom of that blue zone just to break even. And then I got to go all the way up to the top of that blue zone in order to hit my maximum profit, which is at around 74. Now, the maximum loss on this trade is only 50 cents or $500, where my maximum gain is $1,500. And again, people mistakenly assume that if I'm only risking $500 to make $1,500, that this is probably a really good trade. Would you agree? Maybe not. Again, look at how much this index has to move in order for this to be a good trade. In order for this to be profitable, I've got to have a very sharp upside movement.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.